Welcome to BDO's Working in Australia webinar series and our end of financial year compliance session. My name's James Trainer and I'm a partner in BDO's Sydney office, and I'll be moderating today's session. Before we get underway, I'd like to acknowledge the traditional custodians of the country throughout Australia and their connection to land, sea and community. I'm here on the land of the Gadigal people of the Eora Nation, and I'd like to pay my respects to elders past, present and emerging, and to any Aboriginal and Torres Strait Islander peoples joining us today. Welcome everyone. Do you know that there are around 1 million employers in Australia? And each of them will need to consider the information that they have to report for all of their workers. And I use the term workers purposely because the obligations that sit with employers don't just arise for common law employees. They arise for directors, for sole traders, for company contractors. So there's a range of issues that each employer needs to consider at financial year end. But don't worry, we know it's hard, but today we've got some experts who are going to help unravel some of the mysteries that employers need to consider when it comes to year end. Joining me from BDO are Stephanie Molino, Ben Watkinson and Nadine Shaw. They're going to lead us through the technical challenges that employers face, covering issues like employee share schemes, single touch payroll reporting, superannuation guarantee and payroll tax. And we're also delighted and indeed privileged to have joining us today from the Victoria State Revenue Office, Andrew Hoskin and Frank Cummins, who are going to share some insights into the revenue side of things and give us some help, give you as employers some help around what are the sorts of things you need to be focused on and what are the sorts of things that revenue is looking at and expecting employers to get right. So without further ado, I'll now hand over to Nadine to take us through employee share schemes.
Thanks, James, and hi, everyone. So as James mentioned, my name is Nadine Shaw. I'm a director in our Global Expatriates and Employment Tax team. And I pretty much specialize in all things expatriates, payroll, and employee share schemes, which is what we're going to be talking about today. So for the next couple of minutes, I'm going to be discussing your ESS reporting obligations that you should be aware of if you have got an employee share scheme in place. Now, this is quite an interesting area, and it poses a bit of challenge with employers, simply because employee share schemes are not reported as part of your mainstream reporting, such as your single touch payroll. And because of this, ESS reporting often gets missed. So as we near the end of the financial year, employers should be thinking about what your reporting obligations are if you have in fact issued shares or options to your employees under an employee share scheme. Employers need to be aware that they need to report to both your employees as well as to the ATO. You need to provide, for your reporting to your employees, you need to provide your employees with an employee ESS statement by the 14th of July, following the tax year in which your shares or options become taxable. Now, the 14th of July date is essentially meant to align around about the same time that you as employers need to be providing your STP income statements to your employees. And it basically just gives your employees all the information at hand all at once so that they can go off and prepare their individual personal tax returns. So it should be noted that for employee share scheme reporting, you as the employer, the shares might not be issued in your company as the employer. It might be issued in a headquarter company. In some cases, the headquarter company might even be a foreign employer. But just noting that you as the Australian employer for your Australian employees, the reporting obligation ultimately sits with you still. Also with ESS reporting for your employees, if you've issued shares or granted options to your employees, you need to be providing your employee with an ESS statement. Now, in some cases, employees are able to nominate an associate, and that could be a spouse or a trust. But ultimately, you've still got to issue, it's that particular employee that you've got to issue the ESS statement to. Similarly, if you're issuing shares to directors or sole trader contractors, again, you still have to provide ESS statements to them as well. When it comes to reporting to the ATO, you need to provide you need to lodge your annual ESS reporting to the ATO by the 14th of August, following the tax year in which your shares or your options become taxable. Now, it is possible for your employers to do you as employers to do ESS reporting through the ATO business portal. However, just bearing in mind that there are certain limitations when using the business portal. It's quite an administratively burdensome process. It's time consuming, it's quite manual, and you've essentially got to report line by line per employee, which kind of leaves a little bit of potential risk in case you have any input errors. Some of the limitations also include the fact that if you have more than 50 employees that you're reporting for, or if you have more than 3 share schemes, the ATO portal doesn't allow you to actually do the reporting. And so you've actually got to seek professional assistance from a provider that actually has got the necessary software. Then just moving on to the next slide. So over the next couple of slides, I'm going to be discussing the different employee share schemes that are out there, but more so from a perspective of when the taxing point arises, and thus the reporting obligation for you as the employer. So the first scheme we have is the $1,000 tax exempt scheme. Under this scheme, your taxing point is upfront at the time that you're actually granting the shares to your employee. And essentially what you're reporting is essentially the discount amount, which is the market value of the shares at the time that you're granting the shares to your employees. More likely than not, the discount value, as the name says it, is likely to be $1,000 or just under. And so the employee will use the statement to populate their tax return. And if they are eligible for the concession under this scheme, then they can actually be exempt from paying tax on the ESS discounts. The next scheme is your ESS startup schemes. And interestingly, under the startup concession, if you are eligible for the startup concession, you have issued qualifying shares or options under the scheme. The taxable value from an income tax perspective allows you to actually reduce the taxable value to a null value. However, just because the value is null, it doesn't mean that you don't have a reporting obligation. You still have to report. So we have issued qualifying shares and options under the startup plan. You must report at the time of grant. And on your ESS statement that you're providing to your employee, in the case of shares, you need to report the number of shares, the market value of the shares, the acquisition price, and the acquisition date. In the case of options, if you're reporting to your employees, you need to disclose the number of options, the market value of the shares at the time that you're granting the option, the exercise price, as well as the acquisition date. Then our next scheme is our taxed upfront scheme. And again, as the name suggests it, these shares and options are taxed upfront at the time that you're granting your share or your option. So in the case of shares, your discount that you're reporting is your market value of the share at the date of grant, less any amount that the employee would pay if they paid anything to acquire the shares. A little bit different in the case of options. So because options have got intrinsic value, therefore, in order to determine the market value of the option at the time of grant, the income tax legislation has a set of valuation tables which are laid out in the regulations, and this essentially helps you to value your option. Now, your tax upfront schemes are typically the schemes that don't otherwise meet concessional treatments, such as if there's no real risk of forfeiture or there's no disposal restrictions. So you wouldn't otherwise be allowed a deferral. You're actually being taxed upfront. Next slide, please. Then we're moving on to our deferred schemes. So this type of scheme is broadly available to your employees. And typically contains a real risk of forfeiture, such as vesting conditions, or potentially it could be a salary sacrifice, for example, a salary sacrifice arrangement, whereby you as the employer, you allow your employee to forego or sacrifice up to $5,000, and in exchange, they get shares. So where your scheme meets the necessary concession for deferral, you can actually push the taxing point out. It's no longer at the time that you're granting the instrument to your employees. It actually gets pushed out to a later deferred taxing point. Now, this point would be the earliest of when there is no longer a real risk of forfeiture and the scheme no longer genuinely restricts the disposal of the shares. It can happen earlier, but the longest that you're able to actually defer a scheme is 15 years. And while we don't often see that this doesn't really happen very often, we don't often see schemes that actually roll out longer than 15 years. But it is worthwhile noting that if your employees don't actually exercise or the options or shares don't actually vest by the time it comes to 15 years, then at that 15-year mark, you actually have got a taxing point and a reporting obligation. So in the case of a deferred scheme, the discount that you're reporting is essentially the market value of the shares or the resulting shares at that deferred taxing point, less any amount that that the employee would have paid if they did pay something such as an exercise price. And that's what you would record on your ESS statements and again to the ATO. Now, importantly, when it comes to deferred schemes is the 30-day rule. So what the 30-day rule basically says that if your shares or options have reached their taxing point and the employee then happens to dispose of their shares within 30 days of that taxing point, you're actually able to push the taxing point out even further to that date of sale. So as a quick example, if we have an employee who exercises their option on the 15th of June, that's the taxing point. So you as the employer would ordinarily have a reporting obligation for the tax year ended 30 June 2025. Now, let's say, for instance, your employee then happens to sell the shares on the 10th of July, which is within 30 days, in which case you're actually pushing the taxing points out even further to that date of sale, to the 10th of July, which then coincidentally then falls into the next financial year. So you're not then having to report in FY25, you're actually pushing your reporting is then only the following year in FY26. Now, I appreciate that not all employers would necessarily be privy to this information, and they might not even know that the employees have sold their shares. And that's completely fine because the ATO, they will accept that if you don't have the information at hand, it's perfectly fine to just report at your normal taxing point without considering any sale of shares. Then on to our next slide. When it comes to ESS reporting, there are some tips that we have, and there's also some traps that we typically see in practice. One of these is if you have got expatriate or mobile employees, where you as the employer actually have a choice on whether to report the full discount amount, or you can actually choose to only report the assessable portion. So for example, where you have an expatriate employee who comes to work temporarily in Australia on a temporary visa, they're essentially able to apportion their ESS discount, and they're only taxable in Australia on the portion of the ESS discount that actually relates to services performed in Australia. So if you as the employer, if you have this information available and you do want to, you absolutely can apportion the the ESS discount at the time of reporting and just report the assessable amount. And again, if you don't have that information available, it's perfectly fine to just declare the gross amount, and then it's up to the employee to then report it correctly in their personal tax returns. The important thing is to clearly communicate to your employees on what basis you're providing your reporting to the ATO. So example, if you did decide to apportion your ESS discount, to make it very clear to your employees that you've reported the assessable amount so that they don't go and further apportion the ESS discount in their tax returns. The next tip that we have is to do with indeterminate rights. Now, an indeterminate right is essentially a right that you grant to your employee, whereby when at some point in future, the employee is able to either redeem in the form of cash or they can redeem in the form of shares. Now, just noting that if you do redeem in cash, then it's essentially treated similar to a bonus, where you're having to report it through STP, withholding the necessary pay-as-you-go and then contributing the super as you would ordinary income. However, if you would redeem in shares, then you would go through your normal ESS reporting channels, as I've spoken about before. Now, the thing to be aware of is if you happen to have an indeterminate right that you happen to tax upfront through ESS reporting, and then down the track, the individual lands up actually redeeming in cash, you've actually got to be mindful that you've got to go back to that prior year in which you reported the ESS upfront and actually have it amended and removed from the ESS reporting, because you're then having to report the cash through pay-as-you-go through your STP. On the slide, the last one is your tax file number. So as I mentioned to you earlier, ESS is not reported through your single touch payroll, your mainstream, and therefore there's generally no pay-as-you-go withholding on ESS income. However, in the event that your employee doesn't have a tax file number, or if they don't provide you with one, then it is your responsibility as the employer to actually withhold pay-as-you-go at the top marginal tax rates. Just the next slide, please. Thank you. So I briefly touched earlier on the startup concession scheme, where I spoke about the taxing point for the qualifying shares and options to be upfront at the time that you're granting it to them. And it's quite a hot topic, and this is the misconception, is that employers think that because under the income tax rules, the taxable value is actually reduced to null, that there's not actually any ESS reporting obligation. And this is definitely not the case. You absolutely have to report upfront at grant, you have to provide your ESS statements to your employees, and you have to report to the ATO. So failure to report any qualifying shares or options could actually result in not only failure to lodge or administrative penalties, but it could also compromise the eligibility for the startup concession. So when you have issued shares or options under a startup, the ATO would ordinarily expect to see the reporting upfront at grants. And if you as the employer fail to actually report at grant, then the ATO might actually treat or not realize and actually just treat the scheme as an ordinary scheme. The startup concession has very strict criteria, and one of these criteria is the proper reporting. So non-compliance could disqualify the employer from offering the concession in the future as well. Furthermore, from an ESS perspective, again, as I mentioned to you, under the income tax concession, your taxable value might be zero. However, be mindful that if you're reporting for payroll tax purposes, there could still be a value. It's not aligned. So I guess this kind of just reiterates some of the challenges that employers face, especially around startup concessions. On the next slide, just again, your ATO portal reporting, as I mentioned to you earlier, you absolutely can do the reporting yourself. However, be mindful of the limitations. And those are the fact that you can't, if you have more than 50 employees or more than 3 share schemes, you're not able to report yourself. And so most companies would actually refer to a tax agent or a professional who actually has got the software to report, because most employers don't typically have this type of software, and so they would typically seek assistance from a tax agent. Now, the good thing with going through a tax agent is, apart from the reporting, tax agents can actually help you to actually review your share plan and just identify that you are, in fact, correctly reporting at the correct taxing points. And they can also help you with your reporting, but even more so, your employee ESS statements. If you have a lot of employees, you're having to generate individual employee ESS statements for the entire population of people who have ESS. And again, it's quite an admin burden, it's time consuming. So if you're going through a tax agent, they certainly can help you to actually generate those ESS statements in bulk. And then just lastly, on my last slide, so this is actually the point where the ESS reporting actually tends to overlap a little bit with payroll tax. So it is kind of interesting. It's a little challenging because the ESS reporting, the rules are not, they also need to be, or sorry, they don't necessarily align to your payroll tax rules, and there's different rules in different states. So you've got to be very careful and very mindful of the different rules. So say, for example, for a deferred tax scheme from an income tax perspective, the taxing point for income tax might not necessarily align from a payroll tax perspective. As an example, in Victoria, New South Wales, SA, and Queensland, the employer can actually choose to either declare the ESS at grants or at vest date. And then again, noting that vest date might have a different definition to the Income Tax Act. So in terms of your payroll tax legislation, the vest date is essentially the earliest of, in the case of shares, when any condition attached to the share has been met and the employee's legal interest in the share cannot be rescinded. In the case of a right, the vest date is when the right is exercised. And if none of those occurs, then it will be within 7 years from the date of grant, which then you can clearly see, if you recall, from an income tax perspective, that period was 15 years. And in the case of state payroll tax, it's 7 years. So there's a clear misalignment there. So something just to be mindful of. And then just lastly, just in terms of valuing your ESS discount, as I mentioned to you earlier, your income tax value may not necessarily be the same as your payroll tax value. Specifically with startups, for example, under the startup rules in your income tax legislation, there's certain safe harbor valuation methods, such as your net tangible asset value, that you can use to value from an income tax perspective. However, bearing in mind that from a payroll tax perspective, some states don't necessarily recognize that methodology for valuation, so you might actually have a mismatch in values as well. So something to be very careful of. So I guess just to sum it all up, it really is important to understand your employee share scheme that you have and just how it works, and just to be fully across what your reporting obligations are, and to seek further advice if necessary. Because essentially what might seem relatively straightforward may have its own little quirks or complexities. And if you fall foul of any of your reporting obligations, it could actually have some really significant consequences for you. So again, if you have any need for any assistance, please feel free to reach out. And with that said, I might just hand over to Steph.
Thank you, Nadine. That was a really great overview of employee share schemes. And with financial year end come a whole host of year end reporting obligations in addition to ESS that Nadine just covered off on. So to begin with, single touch payroll. For those of you paying employees through STP, and I expect that's all of you, there is an obligation to issue a year-end finalisation declaration, which is due by the 14th of July. Assuming you're paying all of your employees through STP, you won't need to issue any payment summaries. Having said that, if there are employees or potentially you're paying someone outside of STP, then you will need to issue a payment summary to those individuals, and you'll also need to lodge a PAYG annual payment summary with the ATO. Now through STP, By paying and lodging your declaration through STP, employees will then have access to their finalised information through MyGov. So there's no need for you to, as I said, issue any separate payment summaries. Now, Single Touch Payroll will cover off on all of your payroll data, but don't forget there are certain components that you'll need to manually include. That is your RFBA and your RESC amounts. So with the RFBA, that stands for Reportable Fringe Benefit Amount. If you've got employees who received taxable fringe benefits that have a reporting obligation and that total is in excess of a $2,000 threshold, then you will need to include that RFBA as part of your end of financial year finalisation. And equally, RESC, which stands for a Reportable Employer Superannuation Contribution, that applies to those employees who could have salary sacrificed additional superannuation, or they have a capacity to influence additional superannuation contributions over and above the minimum under the SG legislation. So those RESC amounts are also required to be reported on an employee's income statement. So again, don't forget to incorporate that as part of your finalisation of STP data. Superannuation. So that's another obligation. We've got our June quarter where contributions are required to be remitted into funds by the 28th of July. The rate for the June 2025 quarter is 11.5%, but you'll see on the slide from 1 July 2025, the SG rate has increased to 12%. That is a final scheduled increase. So no doubt you're all aware that the government introduced a transitional increase to the SG rate over many years. It was previously fixed at 9% for many years, and then there were the gradual increases until we've had the past few years a 0.5% incremental increase. Now we've reached the 12%, so that's that final scheduled increase. No doubt this is something you've dealt with in previous years as part of the increases in the past, but it's the impact on employees that you need to think about. And the impact is dependent on whether your employees are paid under a total employment cost or base plus super. With total employment cost, what that means is the SG increase won't impact on the total cost of employment to your employees. So they'll still be getting the same total package, assuming their package is unchanged. But the proportion of superannuation versus salary or wages will change. So they'll have an increased superannuation contribution and a corresponding reduction to their pay. Now, I know a lot of organisations have chosen where they have a total employment cost remuneration arrangement to increase the employee's package by at least the superannuation amount, so the employee doesn't feel worse off. For those employees who are paid on a base plus super model, the increased super percentage will mean their base will remain the same, but their superannuation contribution will increase. And again, that's assuming there's no other changes outside of the super increase. Now, the 12% rate that applies from 1 July 2025, it's important to note that that is applicable for all salary and wages paid to eligible employees from that date. So that's the case even if you are paying an employee in arrears and some or all of the services that have been performed relate to a period pre-1 July. It's based on when the wages are paid that you then need to calculate your super, so that 12%. And then at the bottom of the slide, you'll see we've got the FY26 rates and thresholds around the maximum quarterly contribution base. That's for your higher income earners, and that will increase to $62,500 per quarter. What that means, if you have a high income earning employee who earns more than that $62,500 amount on a quarterly basis, you will still comply with your minimum super obligations if you cap your contributions at the $7,500. And that number, you might see that $7,500 is a quarter of the concessional contributions cap of $30,000. So that way the employee will not be in breach of that concessional contributions cap. I couldn't not comment on Payday Super. So I'm sure you've all heard about Payday Super. It's the scheduled measures that will take effect from 1 July 2026, so 1 year away. Now, payday super is a move away from a quarterly regime. Basically, SG contributions will align with an employee's payday. So basically, when you pay your employees, you will then be required to make the super contribution. Now, that's going to pose some challenges for those organisations who have a combination of pay periods. So if you've got monthly, fortnightly, weekly pay runs, you're going to need to implement type processes to ensure that you are then getting contributions into funds by the applicable period, 7 days at the moment under draft legislation, of payday. The draft legislation was released in March 2025. We are still awaiting final legislation. However, employers need to ensure that you are preparing for payday super, because payday super is basically going to give the ATO more transparency on your superannuation contributions. So at the moment, STP gives the ATO transparency on pay information, given that real-time reporting. The missing piece is superannuation. So that's what this is seeking to do. It's to bridge that gap between the information that the ATO is currently getting. So by having that greater transparency for organisations who may not be complying, or they may not have something configured in their payroll system correctly, they may not have a process which enables them to get contributions into funds by the required timeframe, those types of issues will be detected under payday super. So we're strongly encouraging organisations to be proactive. Whilst we still have a year until payday super takes effect, now's the time to review your compliance, review your processes, your procedures, your governance, your payroll system to understand how each wage code is currently configured for superannuation guarantee purposes, and to then ensure that you're implementing the required changes to ensure compliance. And in the meantime, we're awaiting final legislation to understand whether there's any deviation from the current draft legislation and what changes to expect. So it's a watch this space for payday super. And now onto payroll tax. The annual payroll tax reconciliation due date approaching. So the lodgement date across the various states and territories is either the 21st of July or the 28th of July. As part of your annual reconciliations, you are basically lodging your annual taxable wages. So your monthly returns that you're lodging typically by the 7th day of each month, you typically lodge one for July until May, and that's basically an instalment towards your year-end payroll tax liability. So you're doing a true-up by lodging your annual reconciliation. For organisations who employ cross-jurisdictionally and potentially have grouping obligations, it's important to note that you have to declare in your payroll tax returns both your state and your Australia-wide taxable wages, and it's from a group perspective. And the impact of that is to assist with quantification of your tax-free threshold, which the designated group employer is entitled to. Now, when calculating your taxable wages, don't forget your non-payroll items, your fringe benefits, making sure you communicate with your tax or finance team to confirm the total FBT liability and therefore the correct amount to be disclosed in your annual payroll tax returns, including what amount if you are employing across different states. Your contractor payments. Typically, contractors won't be paid through payroll. They'll be paid through accounts payable. So it's about reviewing all of your AP data, identifying your contractor payments that are taxable, those you determine are not taxable, what exclusion is applicable. And you'll see I've mentioned WA on the slide. WA is the one jurisdiction that does not contain relevant contract provisions from a payroll tax perspective. So the benefit for those who are engaging contractors in WA, it's only where contractors will be considered common law employees that there will be a payroll tax obligation. And then, as Nadine talked about, employee share schemes. Don't forget your payroll tax obligations associated with your ESS. And the last dot point on the slide just highlights a change to the Victorian payroll tax threshold that takes effect from 1 July 2025. The tax-free threshold will increase from $900,000 for FY25 to $1 million for FY26. And that number on a monthly basis is set out on the slide as well. Now, the important thing to note for organisations who employ in Victoria, the tax-free threshold is now a diminishing threshold. So once your wages exceed a certain amount, you lose part of that threshold until you are actually not eligible for any threshold at all once your wages exceed a $5 million threshold. So that's my overview of STP, superannuation and payroll tax. And now I'm really excited to welcome you to our State Revenue Office representatives today. We've got Andrew Hoskin and Frank Cummins from the SRO who have kindly volunteered their time to join Ben and I for a panel discussion and really get some insights from the SRO, because that's where I think our clients, organisations and employers benefit the most. We as advisors can give you the updates and the developments, but it's hearing it direct from the SRO, what your areas of focus are, what you see organisations doing wrong, that gives our clients the most benefit. So thank you for your time today. I think I'll open up the floor.
Thanks, Steph. And I'd just like to obviously echo those comments and thank Andrew and Frank for giving up their time today. I know everyone, finds it really valuable. And to that point, I guess I might kick off with a general sort of question. So Andrew and Frank, I guess from our perspective, as advisors, I guess we're seeing, increasing use by the Revenue Office of, various data matching and data sharing amongst offices. I guess, is there anything that you can share and any particular insights that you wish to share in that regard?
Yeah, look, Ben, thank you. And thanks, Steph, as well for your kind words. I mean, certainly data matching is a significant part of the process that our office undertakes. Before really identifying targets for compliance activity, we get a lot of data, as I'm sure you would expect from the ATO, things like FBT returns, we get information relating to single touch payroll, we get all sorts of bits and pieces, we get information regarding contractors and those sorts of things. The real value for us is in being able to use that data to really pick a target and to pick a target where the data suggests that there is likely to be an error. And the real value for that is that we're not going to waste your client's time if everything looks to be okay. And so realistically, if somebody does get contacted by us for a compliance review, it is likely that something is awry. And we won't necessarily be clear and concise up front about what that actually is. And our general approach is to give people the opportunity to make a disclosure before we embark upon a full compliance review. But some real value, I guess, in making sure that if we do undertake a compliance audit, that it's likely that there will be either tax payable or a refund payable in more than the majority of cases.
Thanks, Andrew. I think that's really useful. I know, Steph, you had some specific insights and questions that you wanted to raise in respect of data matching.
I do, Ben. I was curious about, so you're sharing, I think we've long known about the data matching, because that's what we see come through with compliance activity for our clients. But we're dealing with a state-based obligation, state-based regulators. Curious to understand what happens when you are conducting an investigation into an organisation. You might have data matched with FBT or something similar with the ATO, and you know that the organisation has employees and payroll tax obligations across various states and territories. What typically happens then? Is it at the conclusion of your audit? Are you looping in with the other jurisdictions to put them on notice? Or can you share some insights there?
Yeah, sure, Steph. Yeah, so it kind of depends sometimes. So I guess ultimately with the outcome being that in most instances the information gets shared, it's probably a real difference in terms of the timing of the sharing. In some instances, the sharing will be along the way. In others, where potentially the issues aren't so great, it might well be at the conclusion of a review. But it's a pretty reasonable assumption to say that if a state does a compliance-based audit and detects that there's an underpayment and that the employer is a national employer, that most of the other states will be given information that suggests that there needs to be some further work undertaken. So, you know, it is, as we can all laugh about the harmonisation, I guess, approach that we have with Parotax, where we now have almost quite a disharmonised situation. But I guess the real value with the various approaches that the revenue officers take to keeping in contact with each other through interjurisdictional committees, such as our compliance interjurisdictional committee. We have a tax law committee where all of that sort of information and processes and findings are shared. So a very accurate and reasonable assumption that information is shared, but it's just a matter of timing.
Thank you. And I think it just reinforces our messaging to our clients. Proactive compliance.
Correct. Oh, absolutely. And I have seen some situations, Steph, where one state has conducted a compliance audit on behalf of itself and other states as well. So, which again adds a degree of to theoretically efficiency for your client as well. They're really only dealing with then one audit rather than 2, 3, or 4. So I have seen that happen as well.
That poses another question for me. It's your point on harmonisation. So how does that work? If you're conducting an audit on behalf of numerous different jurisdictions, each jurisdiction is quite unaligned in how they apply penalties, interest, remission, the retrospectivity period in some cases. Even though we might have very similar legislation, it isn't necessarily applied.
The application is different, isn't it?
Exactly. So does that create challenges when you are conducting an audit on behalf of various state revenue authorities?
Absolutely. And really I guess from the outside looking in, there are a whole range of conversations that go on between the revenue officers that don't necessarily involve the taxpayer in the first instance. So where there are different approaches, then generally those conversations are had sort of behind the scenes and with the aim of obviously coming up with a solution that works for everybody.
Excellent. So I guess on that note, you know, with increasing data matching and sharing and information we've sort of just touched on and talked about, as Steph mentioned, we're coming up to sort of the annual reconciliation process. So I guess, Andrew or Frank, is there any sort of tips or tricks that you would provide to employers as they approach the annual reconciliation process?
Frank's our man for this stuff, Ben.
Yeah, thanks, Ben, Stephanie. Yeah, absolutely. So I suppose the first and probably most important thing is that they actually lodge their annual reconciliation by the due date. So, Stephanie, you did mention a couple of due dates there. So Victorian's due date is the 21st of July. There are no extensions, so no point ringing the office and asking for an extension regardless of your circumstances, because it won't be granted. So 21st of July, lodge and pay. We understand that some businesses might struggle to either know their wages at that point in time or be able to make full payment in that time. However, really important to lodge something by the 21st of July. You're able to amend your annual reconciliation at any time during the year. So lodge and pay something. Okay, you can't set up an official payment plan with the office until you receive an assessment, and that assessment falls due, which by that time there's already been penalties and interest applied. So the best you can do is lodge something, pay as much as you possibly can, set up your own payment plan, for instance. So make a payment on the 21st, then make a payment the following week, etc., as long as you're using the correct reference numbers. So make a contribution by the 21st of July, and that will reduce the likelihood of any or at least reduce the penalties and interest that will get charged. So really important to lodge. It opened on the 19th of June, so plenty of time to lodge. And like I said, you can lodge an amendment at any stage during the financial year. Lodging multiple returns, so knowing, if your circumstances have changed during the financial year. So, for instance, you're a non-group employer, however, you've been grouped during the financial year. It's really important that you understand that you will be required to lodge multiple annual reconciliations for that period. So a lot of the issues we see is that the customers just lodge one annual reconciliation when they're required to lodge multiple reconciliations. Same with lodge, even if you know the wages are going to be under the threshold, if you're registered for payroll tax in Victoria, you are still required to lodge an annual reconciliation. So you need to lodge that annual reconciliation. If you're lucky enough that your wages are under the threshold, it will give you a nil liability at the end of the process. But if you don't make that lodgement, you will receive what we call a default assessment at some point down the track. So really important that you actually get on there and lodge your wages regardless. And then things like correct dates. So reconciliation periods, as I think Stephanie mentioned, the thresholds are prorated. So based on two separate things, one, number of days employed in Australia in the financial year. So really important that those dates are accurate when you're lodging your annual reconciliation. And then, of course, the deductions prorated Australia-wide. So you're entitled to one deduction across Australia, and that's prorated based on the percentage of employees you have in each state. So it's really important that you supply the correct interstate and Australian wages when you're lodging the annual reconciliation. So they're two of the really important parts. When it gets to the wages section, I think, or Andrew might have mentioned, compliance and data matching. When you get to the wages section, there's a lot of components that are attached to payroll tax and that are taxable. Really important, although if you declared everything that was taxable for payroll tax under just salary and wages, nothing would change as in liability-wise for you. However, what will happen is our data matching then says, hang on a minute, this entity hasn't supplied any superannuation or hasn't declared any contractor payments or hasn't declared fringe benefits tax, and we can see that they actually do have those through data matching. That'll be the first point of call where a customer would be audited for payroll tax purposes. So really important, although it's only an administrative thing that they need to do, it's really important that they supply a breakdown of those wage components when they're lodging their annual reconciliation. It's self-assessing, so there's two rates for payroll tax, the metropolitan rate, regional rate. So a lot of issues we see is customers not declaring that they're a regional employee or declaring that they're regional and they're not, although within the AR for Victoria, once they select the region that they have regional wages, it will ask them to declare their total taxable wages and then also their regional wages, and it will determine whether they've met the 85% rule and therefore charge them the correct rate. So that's another area that we see issues with the annual reconciliation. And then, of course, you've got, if you're lodging as a designated group employee on behalf of a group, it's that designated group employer, when it gets to the wages section, it's a must that the designated group employer must lodge the group Victorian and group Australian wages in order to claim the thresholds. So it's really important that the designated group employer knows what each member of the group and their wages that they've paid through the financial year. So a lot of issues we see with either overpayments or groups not getting the threshold is because the DGE is unable to supply that information. So a hint for customers, if they're in a group, is have the ordinary members lodge their annual reconciliation first, because throughout that process, they can authorise for that information that they're declaring for the year to go across automatically to the designated group employer. So if they tick that authorisation field and then the designated group employer lodges into their annual reconciliation, when they get to the wages section and the payment section, that those details will be pre-populated for them. So it really helps in making sure that the designated group employer is lodging those correct group Victorian and group Australian wages. So really important. Another one is declaring those interstate wages. So letting us know that you did actually employ interstate. So we have a lot of taxpayers that will claim the full Victorian threshold when in fact they're not entitled to that because they haven't supplied us with those interstate wages. So and that's as a total. So they just need to add all the wages paid outside of Victoria, add them together and just put them in as one total. So there's no need to break anything down or anything like that. It's just one amount. So that's another thing that we find. The payment section of the annual reconciliation, really important that they review the payments that are pre-populated within the annual reconciliation or aren't there, and make sure you're able to amend the total amount field within the payment screen to include any payments that might be missing, or to exclude any payments that actually might not belong to a customer. Because believe it or not, customers don't set up the pay online functionality, which highly recommend setting up paying online. If they pay by EFT or BPay, they use the incorrect reference numbers, etc., payments go missing or go to the wrong places. So really important that they review those payments, amend the total to include or exclude those amounts, and then put a comment in to say, you know, this payment amount made on this date is missing or it's not missing. It'll do two things. One, we'll be able to find those payments or make the changes necessary. And also at the end of the annual reconciliation, as long as they've put in their correct wages and the payment amounts are all accurate, it'll give them their correct liability at the end of the process. And there'll be no need for any follow-up afterwards. So that's really important. Again, the ordinary members are able to, again, authorise for who's going to make their payment, their liability payment, so they can tick that they're going to make the annual reconciliation liability payment, or the designated group employer is going to make that payment. Really important that they get that right. If they are going to make the payment and they tick that they're going to make the payment, that they do make that payment, because what it will do is if they tick that they're going to make their liability payment, when it comes time for the designated group employer, when they get to the payment screen, it will include that payment, whether they've made that payment or not, if that makes sense. So really important that they get those areas of the annual reconciliation right. And then, of course, the lodgement of the annual reconciliation. You'll be surprised how many people get to the end of it, save and close, and don't happen to go back in and hit that really important lodge button. It's pretty big. I'm sure you have all seen it, but it is really important. We get a lot where they just don't hit that lodge button that finalises it. And then, of course, making the payment. Again, if you set up the pay online functionality, you can future date your payment so that it comes out on the 21st of July. And again, at least you know where that payment's going to go to. However, if you are paying by EFT or BPay, the reference number, really, really important. The reference number changes every single month in Victoria for payroll tax. The reference numbers will change, and for the annual reconciliation. So, and the reference numbers can be quite cumbersome, and obviously errors get made when they're putting those in. So, really important that they do that. Not sure.
Yeah, can I just add a little tiny bit there, Ben, just before you jump in? And sure. I think it's important for us to let all your clients that are listening in to know that what Frank spoke about then from a systems perspective is Victorian systems wise.
Correct.
But from my experience, the process is pretty similar from state to state, notwithstanding that the systems are different. So Frank gave some great insights there into how the process works in Victoria, but things like checking that all the payments that you've made are shown and those sorts of things apply across all the states, right? So, you know, and all of the states have a way for you to modify those sorts of things. The comments that Frank made about designated group employers and those sorts of things, again, apply across all of the states as well. So I think it's just important for people to understand that whilst Frank gave a really detailed summary of how the process works in Vic, the process is pretty much the same across all of the other states.
No, I appreciate that, Andrew. That's really good insight. And I think the key sort of point, which I think is sort of been touched on here, about the sort of annual reconciliation process for employers is, you know, one of the key points I think is really communication, as we sort of touched on within the business. Like there's varying different information coming from different parts of the business. So, you know, having appropriate communication and policies and procedures in place is, you know, really important, you know, in order to ensure an accurate and timely reconciliation. And I guess one of those things where there is communication required, as Steph touched on, in terms of data coming from AP, etc., is contractors. So, Andrew, maybe, it's an area where, we do get lots of questions from clients, how to manage contractors, how to manage the contractor exemptions, etc. Are you able to maybe just sort of share some brief insights as to sort of what you've sort of seen from a best case scenario in respect of contractors?
I think, I think, Ben, the most important thing from a revenue office perspective when dealing with contractors is to understand what your contractors are actually doing, how they're doing it. And because really what we're talking about here is you've got another business that's providing services to your business. For you to be clear and concise around what your payroll tax obligations are on the payments that you make to that contractor, you need to know what they do. You need to know if they employ somebody else. You need to know if they have an apprentice. You need to know if they work for other clients, because as we know, there is one of those exemptions is about where the contractor provides services to the public generally. I've seen examples where employers will have a questionnaire for their contractor to complete out that provides them with a bit of information about, whilst I work for company A, I also do a bit of work for B, C, D, and E. I've got 2 employees, blah, 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 so enough information for the employer to be able to make an informed judgment about whether they clearly do or potentially don't have a payroll tax liability. And I chose my words fairly carefully there because, in some instances, it's clear that you do have a liability, but in other instances, not always clear that you don't. And, that your comments, Ben, about the communication within a business is absolutely imperative, especially when dealing with, some of the stuff that Steph and Nadine spoke about, share schemes, FBT, payroll, contractor data. It can come, all that information can come from 4 or 5 different parts of a business, and then the poor bugger that's trying to complete the payroll tax return has to try to get it right. So it is imperative.
No, absolutely.
And you guys can be engaged to do a wage code review, and that's, but if you're not asked to look at the contractor process, then you can't really advise in that space. So yeah, it's imperative.
No, absolutely agree. And just obviously conscious of time, but Steph, did you have a couple of comments you wanted to make in respect of contractors?
Yeah, contractors. It's the area that I would say I get the most questions from organisations, whether it's from a payroll tax perspective, superannuation perspective. It is complex, particularly because the provisions are not aligned. And the point that you made, Andrew, I mean, with contractors, there could be so many different parts of the business who are engaging contractors. So the key from an advisor's perspective, and I'm sure you'd agree, is having a process in place that is consistent so that you're collecting sufficient information so that at the end of the day, when it comes time to assess the flow-on impacts, what is that contractor classified as? Are they a genuine independent contractor, a common law employee? Yes or no? And then you've got to consider the broadened definition given payroll tax. I think that a lot of organisations make the assumption that if you're engaging an incorporated company, that there's no payroll tax obligations. But as we know, that's certainly not the case.
Yeah, no, absolutely. And it's probably, I mean, Frank and I have just finished an education roadshow, and from a payroll tax perspective, it is probably the biggest question we get as well. How are we supposed to know whether we do or we don't have a liability on the payments we make to contractors? That they are absolutely complex provisions, no question.
It brings the question that, sorry, Ben, to jump in, but I have to ask this because I feel like it's the elephant in the room. We've talked about, I think, harmonisation or disharmonisation, but contractors, anyone operating in WA, you're the lucky ones. There are no contractor provisions in WA. Will Victoria ever follow suit?
Oh my, gosh, it's a big call. 1983, I think, from memory, Steph, the provisions were introduced. So, look, who knows? But I don't know the exact numbers, but I'd be fairly comfortable in saying that payments to contractors make up a fairly significant part of the payroll tax base in all of the states except WA. But as we know, WA has a slightly different interpretation and broader interpretation of what a common law employee is for payroll tax purposes. But look, I can't see it happening in the near future. And but look, employers have our empathy, no doubt, in terms of trying to work their way through the maze of determining in some cases whether they do or they don't have a payroll tax obligation on payments to contractors. But your point about incorporated contractors, it needs to be bold and underlined. If you have an incorporated contractor, it automatically excludes you from having a payroll tax liability.
Yeah, no, absolutely. And I think that's, a really common area that comes up. Again, conscious that we're almost at time, but the one thing that people, regularly ask, and I think given that we've got these two esteemed gentlemen with us today, that just maybe a couple of minutes insight, Andrew, if you can provide on, current or, future areas of focus potentially for Revenue Office. Clients are obviously, really normally keen to hear, so what are Revenue Officers focusing on? So any insights you could share in that space would be great.
Yeah, absolutely. So look, I guess, Ben, easier for me to speak on this just from a Victorian perspective, but we have our compliance strategy available on our website. If you go onto our website and type in compliance strategy, you'll be able to see our strategy for the period 23 to 27. And that sets out the sorts of things that we will do. It doesn't necessarily focus in on particular industries or activities, but, speaking to our compliance people earlier in the week, the key targets for next year remain the same as probably what they've been for the last 10. FBT and data matching, super guarantee and data matching, contractor payments. We've just spoken about the absolute difficulty that employers have in many instances with contractors. But also importantly, one of the topics that we haven't spoken about is wage underpayments and those sorts of things, or more commonly known, I think, in the media these days as wage theft. So those are also targets for our office going forward. But the strategy is on the website. The other thing that I would say, and I guess a bit of self-promotion here, is that the SRO, we've started to run a series of webinars aimed at trying to give people a little bit of insight into what they can expect if they are the subject of an audit. And so if somebody does get a letter from our office suggesting that they're about to go through a compliance audit, my advice would be to jump onto our website, type in customer education into the search field, and they'll be taken to our events calendar, and they'll be able to join one of our webinars, and we run them every 2 or 3 weeks just to give a bit of an insight into what they should expect.
Perfect. Well, I'd like to obviously thank the gentlemen for their time, and that sort of closes the panel. So with that, I will hand back to James to close the session.
Thanks very much, Ben, Steph, and particularly to Andrew and Frank for your candid insights. They're really valuable. And one of the things I took away from all of our presenters today was around communication. Isn't it always funny how things come back to basic things like communication? Getting details of communication about your share plans, about your reportable fringe benefits for single touch payroll, about all of the contractors that feed into your payroll tax return. So it's a really important piece. And by listening and attending webinars and these sorts of things, then you can get a better understanding of what those obligations are. And then, hopefully you don't have to go on to the SRO website and see what happens to me when I get a compliance letter. But nevertheless, that sort of information is available. And that's one of the great things that I think, with the proliferation of information, that there's a lot out there that you can use to help you support and understand and comply with your obligations, because they are complex, and complexity is not going to go away. It will always be there. So thank you everyone today for your time in attending, and for our presenters for your time in putting together your thoughts and your presentations, and sharing those insights with us today.
Our pleasure.
Thank you so much. And one little end bit. Look, there's a lot of information that we provide here at BDO out to our clients, and there's a lot of insights that are available. So if you want some information about events that are coming up, then subscribe through the link there, and you can receive direct insights to your inbox. So we won't spam you. You're choosing to receive them, and you can, obviously modify your choices as you go along. But there's a lot of information out there, and we'd love to have you, consume that. So thanks once again, and enjoy the rest.